Saturday morning to you, and welcome to On the Mark. Alongside Mark Papa, I'm Gary Byron. Mark is the president and CIO of Financial Resources Group. Now, they're out of Glastonbury, Connecticut. You can find them online at www.frplan. That's F as in Frank, frplan.com. More importantly, I would say write this number down, and more importantly, use it. Call it today, call it later today, call it tomorrow, call it Monday. Bottom line is that you call it. It really, and I mean this, it really could be one of the most important phone calls that you make for your future. 860-657-8380. Again, 860-657-8380. I'll give you more of that towards the end of the show. In fact, I'll repeat those points of contact at least a couple of more times before the show is over. Mark, good morning. Great to see you again.
Oh, Gary, awesome to be here, as always. You know, always look forward to being on the show.
Mother's Day weekend, right?
Yes. And
tomorrow to see your mom?
Absolutely, yes. You know, it's always a great day to celebrate your mother.
Every day is a great day to celebrate.
Just so
Mom.
you know, I bought my Mother's Day cards probably like 3 weeks ago, so I got the pick of the litter. It's really funny. You walk into a CVS and all the guys are scrambling, and there's like 3 cards left.
That's
you know,
so true.
And it's hysterical. But you know, obviously you can make it up with some flowers, but and maybe a personal note here or there. But you know, it's fun to see the Hallmark aisle. You know. You know, all these guys standing there.
Take her out for lunch maybe tomorrow?
Oh, absolutely.
Good. I'm glad to hear that. I think it was 2 weeks ago. 2 weeks ago, we were talking about myths, right? And we got a number of myths that we spoke about, but we didn't exactly get through the, you know, entire. I think there's like 10 of them. I don't think we got anywhere near, or maybe about 10 of them. I don't think we got anywhere near the end. I think we ended at 5. So we did the first half. Mm-hmm. Yes. Hopefully we can do the second half, because I think people need to be informed on these. Tell us about what kind of myths these are and why they're so important, and then we'll have you get right into number 6.
Well, this is, you know, one thing that I don't follow, Gary, is conventional wisdom. You have to do the research. You have to look under the hood and find out exactly what's going on you know, because rumors happen, or things, you know, people hear things and it just gets repeated. It's like in politics, if something gets repeated enough and a lie gets repeated enough, it becomes the ultimate truth, unfortunately. Perception becomes reality, and we don't want that because that hurts people. It hurts your investing. It hurts your retirement. And there's just a lot of, you know, you have to be careful. There's a lot of people looking to grab eyeballs and, you know, get your attention, and you shouldn't be listening to that stuff. And I can't tell you how many people still do it. And, you know, again, the people who I'm able to help are the people who are my clients. We don't run any of these issues because we know that they're myths, right? And, so we, on April 25th, went through debunking investment myths, and this was from a really awesome presentation done by YCharts. YCharts is our provider for, we use them for data analytics, portfolio design, research, tremendous company. And they're very similar to Morningstar, which I found out I still have a subscription to. And, you know, we were trying to just use YCharts from now on. That become our go-to. But, yeah, I want to talk about that. So let me just recap what we talked about. We talked about myth number 1, sell in May and go away, and why that was, with 75 years of data, a bad idea. And then market timing is the key to high returns. So anybody who thinks they can time the market, or, you know, and I know a lot of people that say, oh, I should have never sold that stock. I should have never gotten out of the market.
Sure.
And you know, trying to do that, you can't do that consistently. So we talked about, you know, the difference of having something that the study showed, you know, $681,000 by staying the course versus $303,000, you know, if you missed the 10 best trading days. So you can't time the market. Very bad idea. Holding cash is safer than investing. Well, clearly it's not, because of inflation. You actually hurt your future growth, and you'll basically die a very poor person if you do that. So YCharts, again, they compared that $100,000 invested in 1992, and it grew to $2.84 million, or 10.6% at the time. So from so, you know, sitting in cash during that same period, you would have been in a lot of trouble. You would have not had barely any money. You would have had versus $2.84,228,000. So bad idea. Myth number 4, stocks are too risky. Well, I think we know the answer to that. There are certain stocks that are risky. But as we know, the markets do what the markets do over the long term. The markets has been proven. It's no guarantee to the future, but markets have been proven to rise over time, and it's going to have its ups and downs. But over the long term, if you're a long-term investor, you will fare fine. You'll be okay. Number 5, which was one of my favorite ones, and one of these Wall Street has a very, very interesting way of putting things, but never catch a falling knife. Right? And don't try and catch a falling knife. And that is, fallen stocks will bounce back. And we know that if you're just trying to buy a stock because it's really cheap, because it's not well run, or, run well, or it just maybe, the board is just corrupt, whatever. It takes a long time for those companies to come back. May never come back. They may in a bad business. So just trying to buy a stock only because it's cheap, you have to look at what's the future of that company. What's their turnaround story? And, you have activist investors who will go in and rebrand those companies once in a while. But, I don't really think that you want to buy good companies, profitable companies, quality companies, companies that you can own for a lifetime like Warren Buffett. So that's more of where we're going to go. So
let's present to you the second half of that, Mark, and let's talk about diversification as we talk about myth number 6, and we'll head on over to right through 10 before the show is over. Because let's face it, people assume that owning more stuff means that you're better protected, right? Or not, right? Is that even true?
Yeah, it's a very, very interesting, because I think what happens is, depending on what you're trying to do, if you're building a stock-only portfolio, okay, you lose the benefits of diversification when you go beyond probably 30 or 35 companies. That's for your individual stock sleeve. And that has to be done, I think, very carefully. You have to have, multiple quantitative screens before you decide what companies to pick. You can't just, look at the names. You really have to dig in deep into the data before you would do something like that. But let me just say this one surprised me a lot, because when I first saw the data, YCharts compared 2 model portfolios. And the first was a sector ETF portfolio. I see this all the time, by the way, sector betting. And 9% was allocated to each of the 11 major sector ETFs with 531 total holdings. The second was a broad index portfolio. So it's a little bit different. This is betting on sectors. I don't like to do that. I've learned my lesson a long time ago on that. But the second was a broad index portfolio owning we would say 6 large index funds, giving you about 2,935 total holdings, more than 5 times as many stocks. Now, which one do you think performed better?
I guess the bigger one, right? Because it's more diversified?
Mm-hmm. And most people would say that. And I thought the same thing, Gary. So most people would. But the 531 holding sector portfolio delivered a 9.45% annual return since 2021, with a maximum drawdown, now that's maximum loss, of negative 19.3. The more diversified 2,935 holding portfolio only grew 7.33% annualized, but it had a worse drawdown of negative 26.2, which is kind of interesting. And now let's ask why, because those broad-based index funds all held heavily overlapped in the same mega cap tech stocks. Remember the Mag 7? I talked about how we diversified
NVIDIA, Amazon.
We diversified away from them a long time ago. And, NVIDIA, Microsoft, Apple, Amazon, and you think you're diversified, but when you have massive concentration at the top of the stack, you're going to have problems in a down market. So the same names across, and by the way, they had the same names across multiple funds. So true diversification is about reducing overlapping risk, not just counting the holdings.
Well, that's counterintuitive, right? Quality over quantity.
No, that's exactly right. And that's where a carefully constructed model portfolio, like the one we have at Financial Resources Group, with an internal factor tilts and low overlap, beats the naive buy everything approach. More doesn't always mean better. But we like that multi-asset approach, but we're also multi-factor. We're looking at quality. We're looking at momentum. We have another one that looks at free cash flow. So we look at all sorts of different metrics before we put our exchange traded fund model portfolio together, and that's about 10 or 11 positions. exchange-traded funds, big companies, small companies, international companies, emerging markets. We have a very well-diversified gold and silver. We have an inflation hedge portfolio. So we really have a wonderful mixed bag, and it's given us this year tremendous outperformance in 2025, and in current data will show outperformance again above that market cap heavy weighted tilted Mag 7 S&P 500. So we're actually beating that as of this recording. We're beating it. So this show.
Let's look at one more myth. And I think this one trips up a lot of retirees looking for income. They'll say, well, that stock has a 12% dividend yield. It must be a great, safe investment. Well, Mark, I'm going to ask you, is a high yield, is that a good sign? I would.
Well, you always have to question how they're covering that dividend. Right?
Okay.
Or a high yield. So usually, it'd be a below investment grade bond if it's fixed income, or if it's an equity, that would be a very, very high dividend. But this is a classic, what they call the dividend trap. And it's one of the most seductive myths out there, right? Mm-hmm. And here's what actually happens. Stock price falls, say from 50 down to 10. The annual dividend is still $1.20 a share. If the stock dropped from 50 to 10, chances are they're going to be cutting that dividend at some point. So the low yield, so now the yield's 12%. So it looks incredible, but the stock fell 80% for a reason, right? Mm-hmm. So YCharts profiled 10 of the highest yielding stocks of all time in the study. Names like Xerox, Brandywine Realty, Walgreens. They had high double-digit yields, and almost every single one of them had catastrophic 5 to 10-year annual returns, negative 50%, negative 60%, and up to negative 70%. So while you might be getting a nice income, your equity is not in a safe place, so you can lose your principal.
So the high yield is actually a red flag, then?
It can definitely be a red flag. You also have to ask if you see that. Are they using lots of leverage? There's a lot of mortgage-based real estate investment trusts that buy mortgage-backed securities and leverage them up and pay a nice yield on them. But you have to be cautious. You have to know what you're getting into. And often, yes, it's called denominator bias. The yield looks high because that's a pretty cool term, huh? Denominator bias. The yield looks high because the price has collapsed. So you collect a dividend for a quarter or two, and then the company cuts it, as I mentioned earlier. So now you've lost 50% of your principal chasing that income. And at Financial Resources Group, we focus on quality dividends factor. So it's a quality dividend. And we look at companies that consistently raise their dividends over many, many decades, backed by strong profits, good cash flow, excellent balance sheets. And that's how you build a sustainable income in retirement, not chasing the highest yield.
Gotcha.
Okay.
Yeah.
All right. So that's the bottom line. So I know we've covered a lot today, and gone through a lot of these different myths. So I think hopefully, actually, and anybody wants to call in, by the way, and you want a copy of that report from YCharts, you can just give me a call. I'd be happy to sit down with you. I'd also like to review your portfolio. It's not just, by the way, we're not just about your money.
What is YCharts?
YCharts is a service that does data analytics for advisors. Oh. So they were chasing me for years and years and years. And then I eventually got frustrated with Morningstar. We love Morningstar still, but I get frustrated because it was built so long ago that YCharts seemed to be a lot more modern, a lot easier to use. Mm-hmm. I thought it was, I just liked it a little bit. I liked the feel of it, so I wanted to try them out, and I'm very happy with my decision.
Good. I'm happy to hear that. Last week, of course, what we just did was a continuation from 2 weeks ago.
Yeah, I wanted to make sure we got those myths out there.
Yeah, no, that's good. I'm glad. Last week we were talking, I think we were talking about a number of current events. We left talking about Apple and their historic CEO transition.
Yeah, we sort of ran out of time in that, so I'm really glad you bring that up.
John Ternus is now coming back. But I want to talk about, just quickly, before we get into too much detail, I want to talk about the legacy of Apple and Tim Cook and specifically
sure.
Steve, like Jobs.
It's not an easy. There's a big shoes to fill.
Well, I mean, let's look at those three leaders: Jobs, Cook, and now Ternus. What do they each bring to the table?
Well, I think they're obviously I think they were both were in the right place at the right time. And, Jobs came back after being fired by Scully, the former CEO of Pepsi. He was an interesting guy. I used to ride the elevator with him.
Did you really?
I used to see him in the elevator, and I very rarely saw the guy smile. He was a very tough guy, And but I think he taught Jobs a lesson. And Jobs needed that. Jobs needed that reboot. Jobs ended up going to Next. He came up Next Computer. He built that animation company. It escapes me now the name of it. Oh God, whatever. But but a lot of the technology he used at that made it into the iPhone. So it's really pretty cool. But, Jobs came back, with, again, the iPad, the iMac, the iTunes, the iPhone, the iPad. I mean, he did an amazing job. And then he passed away in October 2011. It just seems like yesterday, Yeah. Apple at the time, though, was $300 billion when he when he passed away. $300 billion, Gary. Now, imagine he bought the company when Tim Cook started. So those are big shoes to fill, but then you have to do your best in your own way.
When Tim Cook took over, many called that kind of an impossible task to fill those shoes.
Yeah, I mean, and his record's been nothing more than extraordinary under his leadership. Gary, Apple's market cap grew from $300 billion to $4 trillion. That's more than a 20-fold increase. So think about that: $300 billion to $4 trillion, and that's in a matter of what? I mean, that's 2011. Think about that for a minute. That's a 15-year track record. So that's more than a 20-fold increase. He turned Apple from a hardware company into a services and ecosystem powerhouse. You have Apple Music, Apple TV, Apple TV Plus, Apple Pay, Apple Watch, Apple, AirPods. I mean, you can't go to the gym without see somebody with an AirPods.
Right, true.
And the wearable services business that Cook built now. I mean, it generates over $100 billion a year in revenue, and he navigated global supply chains, geopolitical tensions, trade wars, a global pandemic, and he leaves the company with a roughly $4 trillion market cap and a pristine brand. So, I mean, that's a pretty amazing track record.
I'd say. Folks, you are listening to On the Mark along with Mark Papa. I'm Gary Byron. Mark is very easy to reach. Let me start with his office located in Glastonbury, Connecticut. But you can also find him online at www.frplan.com. And at this phone number, 860-657-8380. Once again, 860-657-8380. 80. So I wanted to make sure that I made sure that I got that in. I think it's very important that people contact you and everything you can do for them. For example, maybe this will give me the perfect opportunity then to have you talk about something that I think is genuinely different about the way Financial Resources Group works with its clients. For example, you've developed what you call a full checklist review. Tell us what that's all about.
Well, Gary, it's like this. It's when you go on a trip, let's say your daughter's going to go off to college, you're packing up her car. Are you going to just let that car leave with the tires bald, the brakes worn out?
Of course not.
Not sure if it has enough of oil, enough of gas. Or you're going to want to bring that car to the mechanic and have them check it over to make sure the car is safe to drive. And that's exactly what we do. I can tell you now, whether people know it or not, because they're not the ones driving their portfolio, it's their advisor. You could have those bald tires, those wobbly wheels, and maybe running out of oil and then the lights on, but you're not seeing it. So what we look to do is we look to go through your entire financial picture. We have a thing called Survivor's Guide where it helps you determine little things like sentimental goods. Who's going to get your sentimental goods, Gary? We had a situation where this woman was playing tennis with her dad for decades, and when her dad passed, she was still competitive and going to tournaments, and she had this tennis racket that you and I wouldn't, pay $2 at a pawn shop for. But what kind of value would that tennis racket have to his daughter? What kind of value would it be?
Sentimental value.
Sentimental value.
Sure.
I mean, can you put a price on sentimental value?
No, never.
So, and in that case, what would happen is if her sister says, I want Dad's racket, what happens to the family then?
Gets torn apart.
Yeah. So, those are the little things we like to focus on like the Survivor's Guide. So we have that. We look at your home insurance, which I think is a big one. I want to highlight that now. I mean, every article I've read on home insurance is prices are going up, benefits are getting reduced unless you're willing to pay extra. And most people think, hey, I have insurance, I'm covered. That happens with both your health insurance and your home insurance. A lot of times, they could change that policy midstream. You were away on vacation, you didn't read it. So we have a way to scrub through that policy with a fine-tooth comb to make sure that what you think is going to be covered is covered. And God forbid, you have your $500 or $1,000 deductible. That's all you want to pay at that point. You don't want to find out that, hey, they're only going to cover a third of the cost or 2/3 of the cost because I didn't have the right kind of coverage. So we do that too. And what kind of advisor would I be, Gary, if I wasn't doing those things?
Well, no, you're right. And this is why people hold you to a higher standard. This sounds like quite a comprehensive review across all of those areas.
Well, it's 21 different points. We're checking your estate planning. We're making sure your will is up to date. Your beneficiaries are titled correctly. A lot of people incorrectly name beneficiaries on their IRAs, and God forbid, if it's not done correctly, you can unintentionally disinherit grandkids or future grandkids. And that happens a lot. And, again, that's why we scrub through it. And most people think they have it done right, and we get them to realize that a lot of times that they don't. So we bring them in, and by the way, we fix those things at no cost or obligation. Easy peasy fix. We set them down for a half hour and get that done. So, yeah, that's one of the other things we do. So I would say, and then just looking at your portfolio, hidden fees, hidden taxes, unnecessary risk, taking on more risk than your advisor's advertising. I would say 99.9% of the people who walk in the door, I'll find that they're taking on more risk than they ask for. And why is that? Because when things are good, guess what? You're paying your guy 1% and your account's going up, and he's getting what? More or less?
It's going more.
He's getting more. So the more risk he's taking, the more return. But then what happens in a down market? So, thank you for letting me do that plug, Gary. And I want to go back onto the apple, if that's okay.
Yeah, please.
All right. And by the way, be careful what apple you bite, right? Because it could be, as you know, poisonous.
By the way, just before you go back to Apple, this checklist, it retails. This is like $2,500 value, right?
I would say minimally. I mean, I call it a $2,500 value because I could easily charge that. I could easily charge $500 an hour. It takes me about 5 hours to put all this stuff together. I don't do that, though, but I'm saying it's a $2,500 value that I think everybody should at least take a stab at and try. It's not a lot of work on your end. You get us some documents. We want to take a look at a snapshot of your home insurance. We want to take a look at, maybe what your Social Security projections are. We'll look at your tax return. We'll look at a summary of your home insurance, and then we look at your investments to see where exactly those hidden fees and hidden risks are. And we just all we're there to do is not tell you what's right or wrong. We're here to bring it to light. So whether it would be that car inspection or what's similar to a home inspection report, you could be buying in a house right now that or buy a house that certainly you would want to waive the inspection. Good luck. Right?
Yeah. All right. So they can get it for free.
It's at no cost or obligation, and we love putting in the work because I can't tell you how often we there's no one who walks into that meeting worse off than when they came in.
That's what we want to hear. Go ahead. Wrap up with Apple. I know you wanted to say a couple things about that.
We did allude to a couple things, about Steve Jobs and then, and Tim Cook, what they were able to do. So let's talk a little bit about why this is so important. Again, it's one of the largest companies in the world. And, Apple, as you said it earlier, is facing a lot of criticism for falling behind in AI. But I think Apple's kind of brilliant in the sense that I think they're kind of waiting to see. I would not doubt they're working on it. But then again, they're the ones, they're not out there spending $500 billion on data centers either. I think they want to play a wait and see approach.
Yeah, but they've been scrutinized because of they've waited for so long too.
Yeah. So it's quite interesting because it's only part of the story. I know Fortune made an astute observation, a couple weeks ago, but the wave of CEO transitions, by the way, let's just talk about this across corporate America, from Walmart to Coca-Cola to Apple, is being driven large in part by the urgency of the AI transformation. So everybody, that's what I call fear of missing out.
But aren't they falling behind in AI?
Well, they could be. We don't really know yet. I mean, they haven't announced much, but they've been very quiet. I think the argument is that this is a sprint, not a marathon, and you need a leader with the technical depth and energy to run it. So that's where Ternus fits the profile. So it's almost counterintuitive that he's a hardware guy. And they're actually taking, I think, a contrarian approach on this. And I think this plays into their strategy. And I think what Apple's going to do is let these guys fight, in the bloody water, and they're gonna wait and see what comes of it, and then Apple's gonna have the blue ocean, so the red ocean, blue ocean analogy. But this gentleman's 51 years old. He's an engineer by training. He went to the University of Pennsylvania for mechanical engineering, and he spent his entire 25-year career at Apple, literally working under Steve Jobs and then Tim Cook. So he understands the culture of the company. Sure. And he oversaw the hardware engineering teams behind the iPhone, the iPad, the iMac, the AirPod, the Apple Watch, and then now the Vision Pro. So it's going to be pretty interesting. But yeah, I think first and foremost, Gary, obviously AI, Apple is lagged behind Google, the Gemini, OpenAI, and so many others. But Siri is at this point playing catch up. But reports indicate that Ternus will he's going to do a major Siri overhaul at Apple's Worldwide Developer Conference in June. So that could be an interesting catalyst, Gary.
Yeah. You want to do I'm at the end of the show. You want to do your disclaimer? I got enough time for that?
Sure, because at that point, someone might say, hey, Mark told me to buy Apple. Most of us own Apple by now. But the opinions expressed during this broadcast are solely those of Mark Papa in his individual capacity and do not necessarily represent the views or positions of Financial Resources Group, LLC. All investments involve risk, including the possible loss of principal. Nothing discussed during this program constitutes an offer to buy or sell any security or investment product, including Apple. Past performance is not indicative of future results, and please consult a qualified financial professional before making any investment decisions.
Wonderful. And let me give you some points of contact that I promised you I would repeat from earlier this morning. First of all, your business, a Financial Resources Group, located in Glastonbury, Connecticut. They're very easy to reach. Start off with their website, wealth of information on there. In fact, you may get questions answered on there. Of course, it may spark some new questions, but it's a wealth of information. www.frplan, F as in Frank, frplan.com. And write this number down, and better yet, we're at the end of the show. Call him right now. Schedule that no obligation consultation. You're going to save $2,500. That checklist is so comprehensive. You heard it. 860-657-8380. Again, 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark with Financial Resources Group. Until next Saturday morning, have a good one, everybody. So long.